while the market is expecting the Reserve Bank of India to hike the repo rate by 50 basis points on August 5, Avnish Jain, head of fixed income at Canara Robeco Mutual Fund, expects the central bank to raise the repo rate by a more moderate 35 basis points because of the recent softening in commodity prices. On the occasion of the launch of the fund house's banking and PSU debt fund, Mr. Jain told Business Standard that investors looking for a high credit quality portfolio and willing to invest for at least 3 to 4 years may go for this fund. I will start our conversation by asking you a few questions around the macro environment, and then we will speak about your new fund offer. There have been some reports in recent times that inflation may be softening. Do you see some light at the end of the tunnel on this count?
Absolutely. I think from where we were about 3 months back when oil was climbing and was at $130, $120, $130 range for a considerable period of time, there were fears that inflation may not come down. What we have seen is in the past few months, and especially in the past few weeks, we have seen the major commodity influencing India's either inflation or current account deficit at the external sector has trended down, and today is actually below $100, which is a good sign for India, especially India, because India obviously imports a lot of its oil requirement, which affects its inflation as well as draws on its currency reserves, as well as on the current account deficit numbers go down. So that is first point. Commodity prices in general have come off from the highs reached after the Ukraine-Russia conflict broke out in February. If you look at the CRB index after climbing from December, January to highs, then it's come down to similar levels at what it was there in December and January. So the retracement has happened there. Government has cut duties on fuel, which also put less pressure on inflation. And I think overall, at least on the primary articles, we are seeing a downtrend in inflation.
So what are your expectations from the Monetary Policy Committee meet that concludes on Friday? By how much do you expect rates to be hiked?
So I think market is discounting another big one, a 50 basis rate point, 50 basis rate hike in repo rate. I am of a slightly different view. I believe that considering the current situation where even in the US markets, people have discounted a slower Fed and probably a lower terminal rate for the Fed funds rate. RBI probably could go to a 35 basis rate hike, reaching slightly more than a pre-pandemic level at a 5.25 in this policy. And obviously, they will remain committed to bringing the rate to neutral, which they've already enunciated in their post-policy meetings and press conferences.
So what does this mean? To what level do you expect the RBI to hike the rates in the current cycle?
My sense is that probably repo rate could be hiked to around 5.75 to 6%. Again, these are more probably that indicates at least 2 more rate hikes and probably 3. I would assume or believe that RBI would be closely watching incoming data, and the impact of their previous rate hikes. Any sharper down move in inflation in coming months, which is probably faster than what they had envisaged or projected in the policy in the earlier policy in June. I think if it is lower than that and they see faster reversal of inflation, they could stop early also, pause early. That does not mean it's the end of the rate hike, because markets are extremely volatile. While we are seeing good times now, things could change fast. Obviously, the China-Taiwan remains on the China-Taiwan-US visit, and all those things are still becoming a little riskier factor right now. So again, markets, geopolitics will continue to basically remain main headline.
We'll now talk about your new fund offer. Could you explain for our viewers what is a banking and PSU debt fund? Where does it invest?
So banking PSU debt, as the name suggests, invests primarily in banking and PSU issuers. So banking names, which are all the banks which are available where your outstanding issuances, especially in larger banks like SBI, ICICI Bank, Axis Bank, Kotak Bank, HDFC Bank. And PSUs are obviously, there are plethora of names like Power Finance Corporation, Rural Electrical Corporation, REC. Then you have the Indian Railway Finance Corporation, you have Power Grid Corporation, which is the PSU, or National Thermal Power Corporation. All these names are top PSUs with top-notch ratings, and that is where this fund will primarily invest up to 80% in these names, which are essentially the PSUs are essentially backed by the government of India, which means that government of India majority holdings in most of these companies. And banking sector, obviously, it is with RBI as the regulator, it's a very tightly controlled sector.
How does this fund differ from, say, a corporate bond fund or a medium duration fund?
So let me take the second part, the medium duration, because there is a difference in terms of both the nature of papers you can take and in terms of duration. So medium duration essentially has to maintain a McLeod duration of between 3 to 4 years. So it is very bracketed in a very narrow range. So banking PSU debt fund being a nature of, if we can call it a thematic fund, because it restricted to certain names, does not have a duration bracketing per se. So it gives more flexibility to fund managers to navigate the interest rate cycles. It is similar to corporate bond fund, because corporate bond fund also does not have duration brackets. But in a sense, it is restricted investment makes it a little probably less riskier, because you can't go and invest in every other name other than banking and PSU. So 80% has to be in the banking PSU names. While in comparing to the corporate bond fund, you have more flexibility both on credit as well as duration.
So what are the advantages of this fund? You said it is less risky. Could you elaborate a little more on the advantages?
So advantages to investors is that so in the past we have seen a lot of funds have some credit events in their portfolios which led to some certain losses to investors. Now this fund being a majority invest in banking and PSU, which is the PSU names, as I already talked about, are backed by Government of India. So it gives you a nature of the instrument you're investing is less riskier than any other comparable private banking name or private sector name. And the banking sector, we know, is very tightly regulated by RBI. And the banking sector as a backbone of the Indian economy has to be very strong. So that itself gives you more confidence in the names you are investing. So for an investor, at least he can be sure that the risk of these funds will be much lower than similar duration, similar managed funds, which does not have restrictions on names. So in that sense, it will be less riskier.
So you have given us a good sense of the credit risk, that this fund is lower on the credit risk. Could you elaborate a bit on the interest rate risk side? How much interest rate do these funds run?
So like I said, there is no restriction on what interest rate risk you can take in this fund. So there probably funds in the peer group where it is running at a lower duration, while some may be running at slightly much higher duration. So it depends on our view where we want to, as a fund house, we want to position it in the medium duration category. So we don't want to be excessive duration also, but we believe that the mid of the curve has the most value in terms of absolute rates. and there investors can benefit more rather than being very low duration, trying to minimize credit risk. But in a situation where I believe and we believe that probably the rate cycle has peaked, it's a good time to really start getting putting a bit of a duration risk in your portfolio. So it's a medium duration. So interest rate risk will remain from a medium duration risk perspective. But like I said, from a credit perspective, the risk is much less.
Are there any risks that investors should be especially wary of when entering such funds? In what kind of environment can these funds underperform?
So, talking about our funds, I think on credit side, we have been extremely careful in the past and will continue to follow that philosophy. Currently, we envisage that we will be investing only in AAA assets in our fund. So from that perspective, credit perspective, the risk is kind of, we try to minimize the credit risk. Interest rate risk is what we feel is the risk the investor will have to face. But if the investor is there for long term, this risk tends to get averaged out over a number of years. Only if somebody is there for short term, the volatility hits you more. Otherwise, we believe that over longer term, the interest rate risk tends to get averaged out because of the cycles.
What is the kind of horizon with which an investor should get into this fund?
So I think minimum should be 3 to 4 years, also from a tax angle for the retail investor. Also because next, like I said, geopolitics is taking center stage right now, and market pricing can be very volatile. I think since most of the central banks have avoided giving forward guidance now, they are saying everything is data dependent. They can swing either side very fast, as we have observed with the Federal Reserve as well. RBI did a surprise rate hike in May. So for the markets, we need to be extremely careful, and in terms of short term, like next 1 year, till inflation globally comes down to a reasonable level, where central banks can assume that they have won the inflation battle. And till that point of time, it is advisable to not take a call that, okay, I will be able to make money in 1 year. So investment horizon has to be longer term. Second is since interest rate cycles are, especially the hike cycles are in the last couple of cycles we have seen, tend to be shorter in nature, like about 1 year, 1.5 years. We already seen a 1 year, 8 months or 9 months of hike cycle. So I think from that perspective, next 1 year is going to be volatile. And if an investor stays for at least 3 to 4 years, he can take full benefit of any downward interest rate cycle, which may or may not start, but probably it will start 2 year hence. So I think from that perspective also, investors should be there for 3 to 4 years.
Do you have any particular profile of the investor who should enter these funds? Who should enter and who should avoid these funds?
I think simply the person who should avoid is who's looking for quick gains. I think it's not for these funds. Probably they should be more suited, or they have a shorter term horizon because they don't have money over 1 year. Then they better suited to be in a lower duration funds, like low duration funds or short term funds. For these funds, I think any investor who is looking to park longer term money in AAA type of assets or banking and PSU kind of names, I think this is a good fund for that, because at least from a credit risk perspective, the risk side, like we talked about, are much lower in these funds, and investors can be conservative investor, especially will find the fund quite suitable for him.
Thank you, Mr. Jain. Thank you for explaining the concept of banking and PSU debt funds.
Thank you, Sanjay.
And good luck with your NFO.
Thank you so much. Thank you so much, Sanjay, for that. Thank you.